All right, guys, let's get ourselves started here. So, everybody, welcome. Happy Sunday night. Um, we wanted to run a really basic intro to options course for the folks in Ascend because Bao has been swinging a few options this past month. And to be totally honest, in these times of like very, very incredibly large volatility, I tend to look towards options for opportunities as opposed to futures just because in many cases, you can give yourself a much larger buffer in regards to like entries and stop losses and take profits and kind of sometimes really farm hundreds of percentages of profit without risking, infinite amounts of risk in options. And so today, I wanted to take this as like a very, very basic options course. And we're not really going to be going into like strategies in options. We will talk very briefly about some different option strategies, but we're really going to just go through generally what are options, what are some of the common terms that you're going to hear like myself and Bao say whenever we're talking about options. We're going to talk about trade mechanics behind options contracts, basic trade strategies, risk management, and then finally, how to set up an options account. And to be totally honest, we're not going to be spending a lot of time on how to set up an options account. I did post up some URLs that I'll share with you guys at the end of this. Webull, Thinkorswim, you know, all of those brokers that allow options trading have really good step by step guides to kind of set those up for you. So without further ado, though, we're gonna hop into what are options. If you guys do have any questions, just post them up in chat, and Bao and I will get to those as we're going through this. So first off, what are options? I'm gonna give you guys a textbook definition, but then we're gonna kind of talk about it a little bit more pragmatically. Say, so an options contract, it gives you the right, but not the obligation to buy or sell an asset at a specific price within a specific time frame. That's not a very helpful definition. So I think one of the cleanest examples and maybe like real world examples that all of us would have experience with is car insurance. So think about when you buy car insurance, right? When you buy a car, it's required that you get car insurance, and that car insurance is basically giving you the right to receive a payout if your car is damaged, right? And so you go to an insurance company and say, "Hey, I will pay you $100 a month. Uh, and then if my car gets damaged, right, I want you to be able to pay me back what the car would be worth in those situations." And so you as the buyer would be paying a premium to ensure that your car would, the insurance, I guess, company would give you money if you broke your car. And the seller or the insurance company, they're accepting your $100 a month to basically take on the risk that you may damage your car. Now, that doesn't seem like a great idea, right? But the insurance company, they're basically betting that you won't damage your car and then they can collect your insurance premium as profit. So they're like, "Sure, pay us $100 a month." And they're just betting that we'll never crash our car and they'll be able to pull in that $100 a month as profit basically for them. And so that's kind of the easiest way that I like kind of comparing options contracts to something a little bit real world in that case. Okay. So next thing, why would we trade options? There's a couple different reasons that you could trade options. The first one is it allows market participants to bet on market direction with less capital. Essentially, this is that kind of like betting that the market will go one way or another. There's also another reason that people would trade it. It's protection of your current asset portfolio. So you could potentially buy or sell options to kind of make sure that if the price of your equities go down, you could then, protect yourself from selling that. Or on the flip side, if you wanted to bet that it would go up, you could sell assets in that case as well. And then also there can just be just straight up income from selling options as well. Now, those two the latter two of these on why you would trade options, I would say are more advanced strategies and in many cases require significant amounts of equity and then significant amounts of assets. So we are going to be focusing on that speculative benefit of trading options. So this one that allows us to basically bet on market direction with less capital. So one of the things that we will do throughout the rest of this presentation is really not only look at Bao's Walmart play that he had, I think last week, but then we will also talk a little bit about the QQQ puts that we were looking at on Friday as well to hopefully kind of pull some of these examples together a little bit better. Mm. So the first thing I want to talk about before we go into some options mechanics is premium. So premium is basically the formal term for what we call the cost of an option. So one options contract, it gives you the right to purchase 100 shares of an underlying stock that you are trading. So if we go back to this screenshot, right? Bao wanted to purchase the option to purchase 100 shares of Walmart at $123 a share. Okay. So going back to premium. So when we're reading contract prices, you need to multiply the price of that options contract by 100 to get the actual cost of the contract. And so in many cases, Bao will be like, hey, I want to buy, these Walmart 123 puts at 23 cents. What that actually means is it's $23 because you have to multiply it by 100 because that options contract is giving you the right to purchase 100 shares of that stock. So every time you see that premium, you need to just in your head multiply it by 100 to get the actual cost of that options contract. So like I said, the options cost is called the premium. So the premium allows you to control large amounts of shares and gain that exposure of large amounts of stock without risking all of that capital. So essentially, right, going back to Bao's Walmart puts that he did, he was basically giving himself the option to buy $12,679 worth of Walmart stock for $44 premium. And we will get into that in a little bit more detail. But you can kind of see, right, that 100x multiplier of options leveraging that premium gives us an opportunity to basically play with large amounts of capital without necessarily needing to have $13,000 worth of capital to kind of put on the market. Okay. I'm going to stop here. I see Dio's writing up a question. I want to just take a pause and make sure. Yes, Dio, this is going to be uploaded. Don't worry. Okay. So premium, I want to just everybody be very aware of premium because we're gonna talk about premium quite a bit, and use the term premium quite a lot when we are trading options. It just simply means it's the cost of the options contract that we're looking at. Okay, so let's go into options mechanics. This big text kind of in the middle. This is how Bao and I are always going to structure whenever we give out an options call. And so for the options contract that I was looking at on Friday, for example, I would have said QQQ, $610 P, 10th of April, 2026, 30 cents. And so what this is showing essentially is QQQ is the stock that we want to trade. The 610 is the strike price that we're looking at, which is basically price we're betting the stock will reach. And then the P, this could either be a P or a C, and that's either the call or a put. And so that's the direction we're betting the stock is going to go. So this, for example, we were betting that QQQ was going to go down in price to at least $610. And then this 10th of April, 2026 is the contract expiration date. So this is the date the contract becomes valueless. And we will talk about that. And then this 30 cents at the very end is the contract premium. And again, knowing that premium, we have to multiply by 100 to get the actual options contract price. This particular 610 put that was going to expire on the 10th of April was going to be $30 at the time that we were looking at it. And so this is kind of how Bao and I will always structure any options call out that we do give in Ascend. Okay. So we saw the mechanics. Now let's go through all those common terms, right? So call and put are the first thing that we'll go through. So again, if we go back up here, right, we saw that this particular one was going to be a put. So if we do a call, it's the right to buy or for us anticipating that the asset price will go up. So if we are doing a call, we're betting that the equity is going to increase in price. If we're going to do a put, it's the right to sell or us anticipating that the asset price is going to go down. So in this situation, QQQ was around, I think, $613 or $614. We were betting that the price was going to go down because of that put to at least $610. Okay. And then the strike price is the target price where the contract may be exercised. And we are going to talk about this. And that is going to determine if a options contract is going to be in the money or out of the money. But basically, for the term purposes of this, strike price is kind of the price that we're betting the equity is going to reach, right? So again, going back up to this particular call, we were betting that QQQ was going to go at least to $610. And then we have our expiration. That's when the contract becomes worthless or the contract literally expires. And then finally, premium, which we already talked about, the cost you pay for the contract at that particular time. We're going to talk about strike price and expiration in great detail kind of towards the end of this, because strike price and expiration is really what you are concerned about if you actually plan on exercising options contracts. But the way that Bao and I really do play options is more around anticipating an increase in premium, essentially. So we will talk about strike price and expiration. Okay, so first off, let's talk about strike price. So again, right, the strike price is the target price where the contract may be exercised. So stock prices are moving constantly, but a strike price for a particular options contract is always going to remain static. And that strike price is going to be the same for the life of the contract. So when you are looking at an options contract, strike price will always be the price that you anticipate, but the premium is going to vary depending on where the actual price of the equity is sitting. So strike price will always be a constant. The strike is determined if your option is going to be a winner or a loser, or what we would consider in the money or out of the money. So when we say in the money, if we go back to that 610p example, if we betted that price was going to hit at least 610 and QQQ dropped to 609, this options contract would be in the money. Now, if we were betting that it was going to go to 610 and maybe price only dropped to 611, that contract still would have been out of the money. And so we'll talk about in and out of the money in a little bit as well. So, but a winner is basically in the money and a loser is out of the money. In the money means that you can exercise your options contract, and out of the money means that it just kind of becomes useless and you kind of lost out on the play. So let's consider that QQQ contract that we were looking at on Friday to see this concept in motion, more specifically the strike price in motion. Okay. So we look to purchase QQQ puts around 30 cents premium with the thought that QQQ price was going to go down on Friday to at least 610 as the vector on the 7-wave 60 was positioned around 610. So again, guys, right? We were looking for that QQQ short. It was basically a traditional gray box setup that we would do with futures. You can obviously do the same with options or, equities as well. 7-wave 60 vector was around 610. So I was like, okay, I was looking at the 610 puts because we were going to ideally hit at least 610. So as the price of QQQ decreased, the option premium on that 610 put went from 26 cents to $1.32 in about an hour. And so this is actually the fractals chart of that particular QQQ options contract. So you can see here, this was QQQ, 2604. So this is, 2026, April 10th. And this is the put, the 610 put. So you can see here kind of at the bottom of the chart, we were looking at kind of buying it around here. It ended up bottoming out around 26 cents. And as QQQ started decreasing, premium on this option contract ended up going all the way up to $1.32. So it was going to be about a 400 to 600% if we could have capitalized on that particular play. Okay. So that's the sample of betting that QQQ was going to decrease in price and then observing the premium of those QQQ puts increase in price. So we got to see that really clean inverse relationship. So then if we look at an actual linear chart of QQQ as an equity, around 12:20 p.m., the QQQ 610 puts went in the money. So again, this is around that 12:20 p.m. You can see the price here is at 610. We had a couple situations where we dipped just barely under 610. So when we looked to buy them at around 6:13 and 11 a.m., they were out of the money because at this point, anything that we were betting that was above 610, all of this price was still out of the money. Not until did we decrease, I guess, get price below 610, did we consider these QQQ puts in the money. Now, the interesting part, though, is that we could have sold it at any time, even before it went under 610, and we would have made quite a bit of money off of that play. So that's kind of the point I want to make here is that most day traders, they sell option contracts well before they expire, but I do want to consider expiration. So again, kind of going back to that QQQ play that we were looking at, I never had any intention of purchasing 100 shares of QQQ, but what I did have the intention of was buying a QQQ put contract relatively cheap with the thought that price was going to go down and the premium of that contract was going to increase. And so my anticipation was to say, if I buy this for 30 bucks, I would love to sell it at 130 and make 400% profit. So I never had the intention of really wanting that contract to go in the money, let it expire, and let me actually exercise the contract. So we will talk about exercising contracts next. So options traditionally, they are meant to be exercised. Like I said, day traders, we are trading options just for the increase in premium, but really this core purpose of an option contract is to be able to exercise them and buy contracts at a discounted price, buy equities at a discounted price, I would say. So let's actually look at what exercising an option would be. So if we bought an option contract that cost us $60, right? 60 cents would be the premium. So that option contract would cost us $60. And we were betting that, say, Apple was going to go up and be $500 by April 15th. And the price of Apple on April 15th ended up being $600. We would then have the right to purchase 100 Apple shares at $500 by exercising our options contract and make an immediate $100 profit per share. So essentially, we would have only spent $60 to make $10,000 of profit immediately. But it's interesting, right? So let's say we buy this at $60. We, bet that price is going to be at least $600, you know, or sorry, we bet that it's going to be at least $500. The price ended up being $600. What we would have to do is then exercise the contract and pay $50,000 for 100 shares of Apple stock. The reason I say $10,000 profit is you could, exercise your option, buy it for 50 grand, and then go ahead and immediately turn around and sell it for 60 grand. And then you would be making that $10,000 of profit. But it's a little scary, right? Because if you exercise that option, guess what? You better have $50,000 of capital in your trading account so you can actually exercise the option, right? And so that becomes a little bit scary for day traders because more often than not, we probably don't have $50,000 or $60,000 in our cash accounts ready to purchase, $50,000 worth of Apple shares, right? So that kind of begs the question. What happens if we forget to close an option contract that's in the money once it expires? This would be really, really irresponsible of us, but it's happened to me before. How it's happened to you as well. This has happened to me. Um, Say, for example, we go back to this QQQ option, right? Let's just say, for example, that price stood under $610. And I was like, oh, enjoying my day, completely forgetting to look at the charts. And I had an options contract that was in the money and it expired at the end of the day. The stock market gods would have been like, congratulations, you got 100 shares of QQQ at a discounted price. And I'd be like, oh crap, I now I have to buy 100 shares of QQQ, right? So that's a question I think that's worth asking, right? So once again, we have the right to purchase the shares, but we do not have the obligation. So if we go back to that very, very first definition of options, it gives us the right, but not the obligation to purchase these shares. So we do have an automatic exercise rule. The Options Clearing Corporation, they have a rule that any equity option that is in the money at the time of its expiration, it's automatically exercised on the investor's behalf because they don't want you to miss out on your big win, right? Like the Options Clearinghouse is like, hey, Amanda did a great job. She bet that QQQ was going to go below $610. And it did. So let's make sure we can automatically exercise this for her so she can have her, discounted QQQ shares. For a lot of people, we love that, right? But there's people who maybe have small options accounts or folks that, like I said, don't have $60,000 worth of capital to purchase 100 shares immediately. So like I say, day traders might not like this. We may not have $50,000 of cash to buy our Apple stocks, right? So if you don't want to exercise the option, you can tell your broker, do not exercise. There is a DNE option that you can set on pretty much any broker that you can trade options with, and it'll just scrap the contract and give you $0. And again, right, the reason the Options Clearing Corporation, they want to exercise this for you is because, in their mind and in the mind of an investor, they'd be like, well, she spent $60 on her contract. I'm imagining that she would want to take her $10,000 of profit and not have a useless option, that would then have a 100% loss. And so, You kind of have to look at options from the mind of like an investor that has the capital that anticipates purchasing their stocks at a discounted price, as opposed to us, where our strategy is truly just to leverage and capitalize on increased premium, essentially. So there is a do not exercise option. Back in the day, this wasn't quite as readily available, and it was actually sometimes a little bit easy to accidentally have options be exercised. I think it happened to me once in like 2022, and it was one of those things that it automatically just purchased me 100 shares, and like 2 minutes later, I just sold it all. But it was a little terrifying for a moment because I was like, oh God, I wasn't anticipating spending $35,000 on stocks today. So there is a do not exercise option, which is wonderful in the modern day. Okay. So I do want to go just very, very briefly into Bao and I's trade strategy. We've talked about it a little bit, but I want to be very explicit with this, right? So we trade options in what I would consider the simplest of ways. We are just counting on premium to increase, and we plan on buying and selling our options contracts well before they expire. So this strategy is called buying long calls or buying long puts. Or simply enough, Bao and I will say, I want calls or I want puts. So again, if you buy long calls, you're betting on the price of a stock to go up. And if you're buying long puts, you're betting on the price of a stock to go down. Again, most day traders who trade options, this is how they are playing these options contracts. They're simply counting on premium to increase based on the movement of the equity that they are desiring, right? So if they want the equity to go down, they're going to purchase puts and anticipate that the stock price will go down and the premium of those put contracts will increase. Similar with calls, right? If they buy calls, we're anticipating stock price to go up and the associated premium with those contracts to increase as well. And so we are going to be buying and selling these contracts well before they expire. I would say this is the simplest and cheapest way to sell options. And what really the only way Bao and I are going to be doing call outs in regards to options as well. The one thing I do want to say, there are kind of going back, if we go back up several slides, right? We talked about um, why trade options. We have this protection of your current asset portfolio and income from selling options. These are some advanced strategies. And, for some of you folks who've maybe been investing for years, you may have over 100 shares of particular equities. This is where those types of strategies come in. But if you have, basically less than 100 shares of any equity in your portfolio, you can't really leverage these too much. But if folks are interested and folks do have larger portfolios, we would be very happy to talk about some of those advanced strategies as well. Okay, so yeah, that is the trade strategy. We're essentially just banking on the premium increasing and pulling profit off of that premium. Okay. Risk management, super basic, right? You guys are already going to know this type of stuff. It's the ground rules that are pretty similar to our futures ground rules. But because options, we kind of have to have our own cash account. Someone did note that there was a prop firm out there that let you trade options, which is cool. I didn't know that was a thing. But Bao and I's big ground rules on this is really to never risk more than 5% of your options account. Cut losses at a maximum of 30% loss and determine strike prices based on our vector locations. Similar to that QQQ play, right? We were anticipating price to go to at least $610 because that's where that 7-wave 60 vector was located. So that kind of helped us determine that strike price. But again, we never really want to be losing more than 30% on a play. As you guys can see, right, whenever Bao is swinging, more often he tends to trim at 100, 200, 300%. And so again, kind of going back to that risk to reward, we really would prefer to see a 3-to-1 risk to reward before we start trimming. And so that's kind of where that 30% stop loss kind of comes into play. So again, kind of like a real world example, if you have a $1,000 account, you're never going to want a position that's larger than $50. And I think this is kind of a tough pill to swallow for a lot of folks, kind of especially in the modern day where prop firms are so prevalent and they give you $50,000 accounts. And it's like not unusual for people to make like two, three, $10,000 a day trading the futures prop firms. Realistically, with options, most people start with small accounts, and the profit that you're going to see is going to probably be a little bit less than what you would see with like a futures like prop firm, for example. And so, my personal account, my small like day trading options account is $1,000, and so every time I do enter into a position, I'm usually not doing more than $50 for my position, which can usually get you one contract. In some cases, it can get you two. But again, this is a really, really good practice of building up small accounts and slowly increasing your equity position through options trading. So this is kind of a disappointing thing to see, but we really try to manage our risk very aggressively and never risk more than 5% of our portfolio whenever we are entering a trade. And then the very final thing that I do wanna leave you guys with, and I'll post up these links on Trading Chat as well, so you can kinda click through them, but, is just how to set up an options account. So some of the common brokers I just wanted to list are Webull, Thinkorswim, and Robinhood. I have a long-term swing account on Thinkorswim that just has a little bit more, capital. My, like, day trading, um, options account is on Webull, and, I know Bao uses Webull very heavily. Their phone app is very clean, and, the the fees for kinda trading options is pretty actually quite cheap, and, their options ladder is really clear, and they have a lot of really good, education kind of on how to trade options, so I'm personally a fan of Webull. I'm not quite as much of a fan of Robinhood because they have, like, automatic liquidation kind of as you get close to end of day and make it kind of restrictive to trade options kind of towards the end of day. So I would say my least favorite one of all these brokers is probably Robinhood. My favorite are definitely Webull or Thinkorswim. And so I did just put some links in here on like how to set up an options application and like what that options application looks like. And then options trading on Thinkorswim as well. The other thing I do want to say is, because you are using your own capital, um, all of these brokers, they do have paper trading as well, which is basically just simulated trading. And so you could all go get the Webull app like right now, and you could go set up a simulation account and put $1,000 in the simulation account and then paper trade to kind of just practice like what the price ladder looks like and kind of how options move. That is something that I would recommend before you do load cash into your account, just so you can get familiar with how the platform actually runs. And I think that's pretty similar, right, with like even the prop firms. We always kind of recommend that if you're going to a new prop firm, just, maybe paper trade for a day to make sure you understand like buy and sell buttons, the break even buttons, bracket orders, and things like that. And so all of these brokers do have paper trading options, which I'm a big fan of because, um, like I said, it's pretty easy sometimes to like make a mistake or fat finger something or like buy something or sell something accidentally. So definitely recommend the paper trading as well. But guys, that was like the world's fastest crash course in options. I think the biggest thing that I really wanted to leave you guys with was like some of those common terms and really kind of like the mechanical structure of what an option strategy looks like and kind of what the general purpose of options are beyond what Bao and I are doing in regards to like pulling profit out of increased premium. So with all of that being said, does anybody have any questions on this? Or do you guys kind of want to let this marinate and maybe have some questions later on it as you start setting up some brokers? I think the final thing too that I would leave you with, so Bao made a comment here on Greeks. We will go into an advanced options course that goes a little bit more into the Greeks and maybe some of the more advanced option strategies as well. But to his point, I wouldn't worry about those too much in regards to day trading quite yet. Um, yeah, I think as we get into more advanced and as more folks kind of open up accounts, we will talk about the Greeks a little bit further. But I do think options is really important to understand because capabilities in fractals, right, like the options analyzer and spread monster, they heavily use options data to understand that market maker exposure and kind of dictate where price is moving based on options contract locations, essentially. So, cool. All right, guys. Well, with that being said, if you guys are interested in setting up an options account, just shoot Bao and I a note, right, in trading chat, and we can all kind of talk about it. But I would really say realistically, I wouldn't try to do less than $500 in a starter account. I feel like in an ideal world, we would recommend $1,000. I realize a lot of people don't have $1,000 of free cash to just throw away if they so please. But like I said, that 5% risk rule, I think $1,000 is probably the least amount of capital you could do to realistically start trading an account. So, all right, guys. Well, thanks for attending. I will get this uploaded on our YouTube and let us know if you have any questions. But otherwise, we look forward to trading some options with you guys in the next couple weeks. All right. See you guys. Thanks a lot.